The most expensive lesson, the investment that looked free. Introduction. In financial markets, few traps are more dangerous than the investment that appears to cost nothing. A stock trading at extreme lows. A guaranteed bonus share. A zero-commission trade. A high yield offered with no risk. It feels like opportunity without downside. But often, what looks free can become the most expensive lesson. This research explores why free investments attract capital, the hidden risks beneath them, and the long-term cost of misunderstanding price versus value. 1. Why free is so powerful. 1.1 The zero price effect. Behavioral economics shows that when the perceived cost of something approaches zero, demand increases disproportionately. Research popularized by Dan Ariely demonstrates that people irrationally overvalue free offers, even when alternatives provide greater value. In investing, this manifests as, it can't go any lower. The downside is limited. It's already crashed. But price decline does not eliminate risk. 1.2 Price anchoring. When a stock falls from $100 to $5, investors anchor to the former price. Behavioral research by Daniel Kahneman shows that anchoring distorts judgment. The previous high becomes a mental reference point. The investor thinks, if it was worth $100 once, $5 is a bargain. But markets do not owe reversion. 2. Types of free-looking investments. 2.1 Deep value traps. Companies in structural decline often look statistically cheap. Low price-to-earnings ratios. High dividend yields. Discounted book value. Yet the business model may be deteriorating permanently. Cheap is not the same as undervalued. 2.2 Guaranteed yield products. High-yield instruments promising stability often hide tail risk. The collapse of long-term capital management illustrates how strategies that seem safe and consistent can carry catastrophic downside. Small, steady gains mask large, rare risks. 2.3 Zero-commission trading. Modern platforms eliminated trading fees, creating the perception of costless activity. But frequent trading incurs spread costs, slippage, tax inefficiencies, behavioral mistakes. Free execution does not mean free consequences. 3. The hidden costs. 3.1 Opportunity cost. Capital tied in a stagnant, cheap asset cannot compound elsewhere. The true cost is often invisible, missed growth. 3.2 Time cost. Years spent waiting for recovery can erode financial momentum. Time is the most finite resource in investing. 3.3 Emotional cost. Holding a deteriorating asset creates cognitive dissonance, stress, defensive thinking. Investors begin justifying the position rather than evaluating it objectively. 4. Why investors fall for it. 4.1 Fear of missing a turnaround. Stories of dramatic recoveries reinforce hope. Examples, like the resurgence of Apple Incorporated in the late 1990s, create narrative bias. But successful turnarounds are rare, and often visible only in hindsight. 4.2 Desire for asymmetric upside. The idea of turning a small investment into a massive gain is emotionally attractive. Low price creates lottery-like appeal. 4.3 Ego and contrarian identity. Buying what others avoid feels intelligent. But being early and being wrong often look identical for long periods. 5. The core lesson. Markets rarely offer something for nothing. If an investment appears free, ask, what risk is the market pricing in? What structural issue exists? What assumption am I making? As long-term investors, like Warren Buffett emphasize, price is what you pay, value is what you get. Sometimes the lowest price carries the highest risk. Conclusion. The most expensive lesson in investing is often not a dramatic crash. It is the slow realization that cheap was not value, but illusion. What looks free can cost time, capital, opportunity, confidence. In markets, if it looks like there is no risk, you probably just haven't seen it yet. And the tuition for that realization can be very high.